You finally get the offer, the number you've been working toward, the salary that, for years, existed as a goal on a vision board or a quiet calculation in the back of your mind. Maybe it's 100,000. Maybe it's 150. Maybe it's the first time in your life a company has offered you a comma in a place that feels significant. You call someone, you feel it, the arrival of something you earned. And then, somewhere between the offer and the first paycheck, reality begins its quiet introduction. The paycheck hits your account. You look at the gross, you look at the net, and the distance between those two numbers is larger than you expected. Much larger. Federal income tax, state tax, Social Security, Medicare, health insurance premiums, maybe a 401k contribution, maybe a few other line items you don't fully recognize. By the time it's over, a $100,000 salary might deposit $6,000 to $7,000 or $68,000 into your account annually. A third of your dream salary gone before you touched it. And if you got a raise that pushed you into the next bracket, someone told you to be careful, told you that earning more might somehow cost you, that the tax bracket is waiting to punish your success. Today, we're going to talk about all of it. What tax brackets actually do and, critically, what they don't do. Why your dream salary delivers less than the number suggests. And how to think about this clearly enough to make it work in your favor rather than feel like a system designed to take what you earned. The biggest tax myth that costs people real money. Before anything else, we need to kill a misconception that is so widespread, so deeply embedded in how people talk about taxes, that it actively causes people to make worse financial decisions. The myth, earning more money can put you in a higher tax bracket and cause you to take home less. You've heard this. Someone at a family dinner said it. A colleague warned you about it before your raise. The idea that there's a threshold where earning more actually hurts you. It is not true, and believing it costs people real money. Here's how tax brackets actually work. The U.S. federal income tax system is progressive and marginal. Marginal means each bracket applies only to the income within that bracket, not to your total income. For 2024, the brackets for a single filer look roughly like this. The first roughly $14,000 of taxable income is taxed at 10%. Income from there up to roughly $57,000 is taxed at 12%. From $57,000 to roughly $115,000 is taxed at 22%. From there to roughly $230,000 is taxed at 24%, then 32%, then 35%, then 37% at the top. Now here's the crucial part. If you earn $120,000, you do not pay 32% on $120,000. You pay 10% on the first tier, 12% on the second tier, 22% on the third tier, and 32% only on the small amount that exceeds the 24% threshold. Your effective tax rate, what you actually pay as a percentage of total income, is significantly lower than your marginal rate. For most people earning six figures, the effective federal rate lands somewhere between 18% and 24%, not 32%. And a raise that pushes you into a higher bracket makes the income in that bracket taxed at the higher rate. Only that income. Your previous earnings are still taxed at the lower rates. You never take home less money because you earned more. Understanding this is not academic. People have turned down raises, avoided overtime, made career decisions based on a misunderstanding of how marginal taxation works. The myth has a real cost. Where the money actually goes, the full picture. So if the marginal bracket myth is wrong, where does the money actually go? Why does a $100,000 salary produce $6,000 to $7,000 in take-home pay? Let's walk through it honestly. Federal income tax is the most visible. Based on your taxable income, which is your gross income minus the standard deduction and any other deductions. You pay according to the bracket structure. For a single person earning $100,000 with the standard deduction, the effective federal rate is typically somewhere around 17% to 18%. Call it $17,000 to $18,000. FICA taxes Social Security and Medicare come next. These are flat percentages taken directly from your gross income before deductions matter. Social Security is 6.2% up to the wage base limit. Medicare is 1.45% with no cap, plus an additional 0.9% on higher incomes. Combined, that's 7.65% of your gross income, $7,600 on a $100,000 salary for Social Security and Medicare alone. State income tax varies dramatically by location. No income tax in Texas, Florida, Nevada, Washington. A flat 3 to 5% in many states. Up to 13% in California at higher incomes. For someone in a high-tax state earning $100,000, state income tax might be another $4,000 to $8,000 annually. Health insurance premiums are often deducted pre-tax, which helps. But even with employer subsidization, an employee's share of several $100s per month is common. $2,000 to $4,000 annually taken before you see the paycheck. Retirement contributions are technically your money going to your future self, not a tax in the traditional sense. But if you're contributing 10% to a 401k, that's another $10,000 of your gross that doesn't appear in your take-home check today. When you add it all together, federal income tax, FICA, state tax, health insurance, retirement contributions, a $100,000 salary in a moderate tax state can produce take-home pay of $65,000 to $70,000. Your dream salary is real. The number you'll actually spend on rent, groceries, and everything else is significantly different. The specific trap: when lifestyle meets net pay. Here's where this becomes practically dangerous. Most people build their lifestyle expectations around gross salary, not net pay. You get the offer, $100,000. You calculate the rent you can afford, the car you might buy, the trips you can plan using $100,000 as the reference point, because that's the number in the offer letter. That's the number you told your family. That's the number that felt like the goal. But you don't live on $100,000. You live on 6 to 7. And 6 to 7, against the lifestyle you mentally built for $100, creates a deficit that feels mysterious and frustrating. This is why people earning six-figure salaries still feel financially stretched. Not because they're irresponsible, because the number they're optimizing their life around and the number they're actually working with are fundamentally different, and nobody explicitly reconciles them at the moment of offer acceptance. The discipline that changes this is simple but rarely practiced. Before you adjust your lifestyle to a new income, calculate your actual expected take-home, net, not gross. Build your financial life around the real number. Treat the gross as a reference point and the net as reality. This sounds obvious. Almost nobody does it automatically. And the gap between gross and net, 30 to 35% at higher incomes, is large enough to create real financial strain when unaccounted for. The deduction system, the part of the tax code that works for you. Here's what the conversation about tax brackets almost always misses. The deduction system exists. It's significant, and most people don't use it as effectively as they could. Your taxable income is not your gross income. Between your gross salary and the income the IRS actually taxes is a series of reductions that can meaningfully lower your tax bill. The standard deduction is the baseline. For 2024, roughly $14,600 for single filers and $29,200 for married filing jointly. This amount comes directly off your gross income before brackets apply. It's automatic. You don't have to do anything to claim it. Pre-tax retirement contributions reduce your taxable income dollar for dollar. Contributing $10,000 to a traditional 401k doesn't just save for your future, it reduces your taxable income by $10,000 today. At a 22% marginal rate, that's $2,200 in taxes you don't pay this year. The 401k contribution limit for 2024 is $23,000 for those under 50. Maxing it doesn't just build wealth, it reduces your current tax bill significantly. Health savings accounts. If you're on a qualifying high-deductible health plan, offer triple tax advantage contributions are pre-tax. Growth is tax-free, and withdrawals for qualified medical expenses are tax-free. The contribution limit for 2024 is $4,154 individuals and $8,300 for families. Few tax-advantaged vehicles match the HSA's efficiency. Business expenses. If any portion of your income is self-employment or you have legitimate business costs, are deductible against that income, reducing both income tax and self-employment tax. The people who experience their dream salary most fully are not the people who earn the most. They're the people who understand that taxable income is engineered, that the distance between gross income and taxable income is something you have meaningful influence over through legal, intentional use of the deduction and contribution system. A $100,000 salary with maximum 401k contributions and an HSA might produce taxable income of $73,000 or less, a tax bill several $1,000s lower than the same salary with no tax planning. That difference, invested over decades, is substantial. The bracket creep problem nobody talks about. There's a real tax problem at higher incomes, not the bracket myth, but something more subtle. It's called bracket creep, and it operates over time rather than at a single income threshold. Tax brackets are adjusted annually for inflation, but wages, in good years, can rise faster than bracket adjustments, which means over time, more of your income gets pushed into higher brackets simply through the normal trajectory of career progression, even if your real purchasing power hasn't increased proportionally. More concretely, certain tax benefits phase out at higher income levels. The ability to contribute to a Roth IRA directly begins phasing out at $146,000 for single filers in 2024 and disappears at $161,000. The student loan interest deduction phases out. Certain credits disappear. The additional Medicare tax of 0.9% kicks in above $200,000. These phase-outs are real. They're not the mythological earning more means taking home less. You still take home more when you earn more. But the marginal benefit of additional income does decrease as income rises, in ways that require deliberate planning to navigate. The backdoor Roth IRA contribution is a strategy that allows high earners above the direct contribution limit to still access Roth tax treatment through a specific conversion mechanism exists precisely because this problem is real and solvable. But solving it requires knowing it exists. What actually happens at the dream salary? Let's put together an honest picture, not to discourage. To prepare, you earn $100,000 in a moderate tax state with standard deduction, contributing 5% to a 401k. Federal income tax, approximately $14,000 to $15,000. FICA taxes, approximately $7,600. State income tax, approximately $4,000 to $5,000. Health insurance employee share, approximately $2,000 to $3,000. 401k contribution, $5,000. Total deductions from gross, approximately $33,000 to $36,000. Take home, approximately $64,000 to $67,000, around $5,500 per month. Now adjust for someone who maximizes their tax planning. Same $100,000 salary, maximizes 401k at $23,000, contributes to HSA at $4,000. Taxable income drops to roughly $60,000 or less. Federal income tax falls by several $1,000s. Same gross, meaningfully different net tax burden, and $37,000 flowing into tax-advantaged retirement and health accounts. The dream salary is the same in both scenarios. The financial outcome is different because one person understood the system and the other simply received a paycheck. Closing. The dream salary is worth wanting. The work to get there is real. The milestone is real. The sense of arrival is legitimate. But the number in the offer letter is not the number you live on. Between the dream and the deposit is a system tax brackets, FICA, state taxes, benefits premiums that takes a significant and predictable percentage before you see a dollar. That system is not designed to punish your success. The brackets are marginal, not total. Earning more always produces more take-home, never less. The deduction system exists and is available to you. The distance between gross and net is navigable with planning. But navigating it requires seeing it clearly, requires building your financial life around net pay, not gross, requires using the contribution and deduction system intentionally rather than passively, requires understanding what the bracket actually does and doesn't do, so you make decisions based on reality rather than a myth that's been repeated so many times it feels like fact. The 32% bracket is not waiting to take 32% of your dream. It's waiting to take 32 cents on each dollar above a specific threshold, while everything below that threshold is taxed at lower rates. While your standard deduction already reduced what gets taxed at all, while your 401k contribution could reduce it further. The dream salary delivers less than the number suggests. It always has. It always will. The question is whether you'll close the gap between what it promises and what it delivers through understanding, or leave that gap wide open and wonder, every 2 weeks, where the money went. The tax code didn't hide this from you. Nobody just told you to look.